here's the thing. Like, I know this might sound like a cliche, but like, you'll hear everyone say this, but it's true. Like, if I could do it, anyone can do it. Like, I'm not a genius. I'm not doing anything special. I didn't crack the code. Like, I'm not outsmarting the market. All my secret is literally just.
Adrian Barr, aka the Canadian T-shirt on YouTube, also one of my really good friends, is a self-made millionaire who has inspired more than 200,000 investors with his realistic personal finance content. Similar to your girl, Adrian is a huge advocate for building long-term wealth the stable, sustainable way. When he talks about investing, you're only getting what actually works for 99% of people in real life. No day trading, no get-rich-quick schemes, no hype. Just dividends, ETFs, how to maximize your taxes, diversification, and actionable strategies for regular people who want to change their lives one step at a time. If you're curious about how Adrian got so successful being a regular long-term investor, and if you've ever wondered which account to use first between the TFSA, FHSA, and RRSP, this episode is for you. One of the OGs of investing channels in Canada, Canadian in a T-shirt.
Hey guys, it's Adrian here, the Canadian in a T-shirt.
Thank you so much for coming on the podcast.
Thanks for having me, Joy. And I know your last guest was Humble Trader, and I gotta say, Shay is a tough act to follow. So, I hope I measure up.
You're definitely going to. My audience already loves you.
Thank you.
Adrian.
Yes.
Before we get into any details, my viewers would love to know. Well, first of all, you're a millionaire now.
Okay.
You just made that video this year.
About a year ago, yes.
About a year ago?
It's been a year and a half now, yeah.
Okay.
Time flies when you're having fun, yeah.
Well, are you at 2 million? Just kidding.
No, not yet. But there'll be a video when I reach that point.
Okay, well, I can't wait.
Yeah.
It's gonna be soon. My audience would love to know. First of all, who are you? What do you do for a living?
Right.
And what are your streams of income?
Okay, cool. Yeah. So before I started YouTube, I've been on YouTube now for 6.5 years. But before then, my career has been a roller coaster.
Yeah.
At the time, I was working as an AI machine learning software engineer for a healthcare company. Best job I ever had. I loved the job. And then as kind of a side project, purely as a hobby, I started this YouTube channel. And then as the years went on, I kind of started, kind of building traction, growing my audience. I got to the point where I was stretched way too thin. I was working, 50, 60 hours a week on my job, another 40 hours a week on YouTube, and I couldn't do both of them anymore. So I had to kind of make a choice, which one I'm going to drop, right?
Yep.
Funny enough, I quit my job right before the AI boom. If I stayed with my job, I'd be making a lot more money. That's a fact. But hey, that's what life is. But then that was about 4 years ago. So since then, I've been a full-time content creator. And I'm sure, you probably share with your audience how content creators make money. But, you need, when you're a content creator full-time, it's not, there's no such thing as a guaranteed paycheck, right?
Yeah.
Your revenue is going to fluctuate month to month. You're going to have some great months, you're going to have some low months, right? I'm a YouTuber, so I get paid a lot on YouTube views. And again, that's not really a lot. If I have a viral video, I could have, maybe I've had months where I made 10K on YouTube, which was amazing, right? But that's very, very rare, right? Most months I'll probably make, 2,000 to 3,000 on YouTube views. But it's not very consistent. It's not really reliable. So that's why you need to supplement that with other streams of income. Things like, for me, my big stream of income is affiliate marketing. Basically, I promote certain credit cards, investment brokerages like Questrade, Moomoo, Wealthsimple. And when people sign up, they get a sign-up bonus, and then I get a little bit of a bonus too. So that's my main stream of income. And then recently, sponsorships, which you kind of helped kind of guide me through that, because I'm very new to sponsorships. I've only been doing sponsorships for 2 years now.
Yeah.
And I always appreciate you and your guidance for kind of walking me through that. Navigating that kind of world. It can be scary. It can be daunting, but
the trade-off is worth it, because I always ask him so many questions about YouTube. So
and taxes.
We got each other, basically.
There you go.
Well, I would personally like to know, I guess, how you got to the $1 million mark.
Okay.
Or maybe habits that you may have.
Sure.
Yeah. And at what age did you reach
so
a millionaire status?
I always track my net worth, my net worth, my expenses, all that stuff. So when I officially crossed the 1 million mark was about 2 years ago. So I was 31 years old at the time. And here's the thing, I know this might sound like a cliche, but you'll hear everyone say this, but it's true. If I could do it, anyone can do it. I'm not a genius. I'm not doing anything special. I didn't crack the code. I'm not outsmarting the market. All my secret is literally just consistency and patience. That's it. Like
Right.
invest every single month, right? No matter, and this is one of the quotes I always say, it's not about how much money you make, it's about how much you keep, right? So no matter what your income is, no matter what's going on in your life, try to find a way to supplement your income by doing, negotiate for a higher salary, work different side gigs, run a side business. But increasing income can be a challenge for a lot of people, right? Ourselves included. But what everyone can do is lower your expenses. And if you do that, if you can increase your income and lower your expenses, that way you're living below your means, you're gonna be making a profit every single month. And if you invest that profit and you do that every month, every year, I'm telling you, time is the one doing the work. Let time run its magic, right? And that was my secret. I mean, if I had a secret, that's what it was. I mean, I've been investing since I was in college, and obviously I started with maybe like $600, grew to $1,000, grew to $2,000. Every single month, I would always, whatever money I could set aside, I would lower my expenses, and I would do some certain pretty extreme things to get there. But almost every single month, I had a profit. And that profit would be invested in real estate, invested in the stock market, invested in ETFs.
Nice.
And, some months were maybe only $50. Some months were maybe like $2,000, right? But you do it consistently, you let time do its thing. And I got to the point where, I crossed the $1 million net worth. And the amazing thing is, most of the money didn't come from me.
Yeah.
Right? It wasn't my money. It wasn't my income. It was the growth of those assets.
Yeah.
My real estate, one of my real estate properties doubled in value.
Yeah.
My TFSA portfolio has doubled in value. My RRSP is almost doubled. And I can't really take credit for that. All I did was lower my expenses, invest as much as I can every single month, and then let time do the rest.
Yeah.
And you kind of asked what are some of my secrets to success, or how did I kind of get to that point? I mean, one thing I always kind of want to harp on is that everybody is able to kind of lower their expenses, right? Because
right.
a dollar earned and a dollar saved is the same thing. It's a dollar profit that you can invest with and have it work for you, right? So, and I know you've shared with your audience many times, the extremes that you've gone to kind of save money, right? Eating scraps off the table at restaurants, using a sponge for 3 different lifespans, right? Those are great, right?
Yeah.
I've done some of those too. That's fair.
Wait, hold on. Before you go any further,
Okay.
I have never eaten a scrap off a restaurant
Did you not?
table.
Oh, I got that one wrong. Well, you know what? I have.
Never. Okay.
I have. So no shame in your game, okay? Yeah. I think I'm projecting there. I did that myself. But as an example, here's something that I think I've told the story in my past videos. But I never had a super high income. Above average, sure, but I never had a 6-figure income ever in my entire career, right? I was working as a software architect. I was working as an AI software engineer. Over my 20s, my salary ranged from $55K to, I think the most was $80K, right? Still above average to be sure, but I wouldn't say I was rich by any regard. But what I was able to do is really cut down my expenses, live below my means, and live a minimalist life. And one of the ways I was able to do that is through my housing costs. So what a lot of people might not know is I never lived on my own until I was 30 years old, right? So for literally my entire 20s, I lived in student housing.
Wait, so you've never lived alone since you were
17. Since 17, I moved out of my parents' house. I've been living with roommates.
17 to 30.
Basically. And then a year later, I was a millionaire.
And then a year later, you're a millionaire.
I'm not saying it was all because of that, but it definitely was a factor, right? Because instead of paying whatever, $1,500, $2,000 a month in rent, I was living in dingy basements. I was paying $250, $300.
$300?
The most I ever paid in rent ever was $500 a month. That was in the basement. That was upstairs. I could afford to live a little bit nicer when I started working my AI job. But think about how much money I saved, right? Compared to everyone else in my 20s, right? So I always lived with roommates with 5 or 6 strangers. Again, it's not for everyone, and of course it's not ideal. I wish I had privacy. I hate doing dishes, coming home from work, and then the sink is full of dishes again, right? I hate that. But I save $2,000 a month, and I'm able to invest that extra $2,000 a month. And you do that every single month, and it compounds. I mean, it really pays for itself. And again, I like sharing the story because I lived with roommates until I was 30, and then a year later I was a millionaire. Right?
Yeah,
that's true. That's one of the extreme cases. Again, it's not for everyone. Obviously, as a single male, I can feel a little bit more comfortable living in a dingy basement with a bunch of strangers, right? And I'm not scared of spiders or all that kind of stuff, right? So it's not for everyone. And if you have a wife and kids, a family, whatever, you might not be able to do those kind of extreme money savings.
Well, that's why you want to start early.
While you're young, while you can, every single dollar you can put aside and invest, I'm telling you, it will pay itself tenfold in the future.
Yeah. I was listening to a podcast and this girl said, or this guy, I'm sorry, hold on. It was Morgan Housel. It was the Morgan Housel. He said that every single dollar that he saved, it was $1 for freedom in the future.
Yes.
Or something like that.
No, I subscribe to the exact same idea.
Yeah. So I think like maybe he didn't grow up very rich. So he's saved every dollar, and then like his mindset was that every single dollar that I save, I can have something else later.
Yes.
So
I'm right there with Morgan, right? Like my goal, I don't care about things. I don't care about buying things. I'm a very non-materialistic person. As you know, look at the clothes I wear. All I wear is basic t-shirts, right?
You're right.
But I love them, right? So for me, high fashion doesn't mean it's a waste of money. If it brings you joy, great, but for me it doesn't. I'd rather invest in my future freedom. I want to retire before I'm 40, right?
Well,
and I'm definitely on track to get there.
Okay. We'd love to hear that because I'm trying to retire too, and so is everyone else.
Let's do it.
I want to know, I guess, your investing strategy then. So you're investing in some ETFs, some individual stocks.
Yes.
Tell me about your investing strategy, and like, obviously you can't copy Adrian's exact strategy because you're not him. But yeah, I would love to know how you're planning to get to retirement.
Love to share it, sure. So I have two kind of fundamental pillars of my investing strategy. One, focus on the long term, right? I don't care about short term. I don't know what's going to happen in the market tomorrow, next week, next month, even next year. I don't know and I don't care. The short term is so unpredictable and it's just noise. So I don't even try to make those short term plays. I care about long term investments. I care about investing in companies that have a long term future.
So when is like, I guess, the least amount of time you think before you sell an asset?
For me, when I'm talking about the stock market, I won't put any money into the stock market unless I know that I'm not going to touch that money for a minimum 3 years. But ideally, 5 years, 10 years, 20 years. The longer, the better. But for me, 3 years is the absolute minimum. If I need this money 2 years from now, I'm not putting it in the stock market. No, I'll put it into savings accounts, I'll put it into GICs, put it into money market funds, that kind of thing. But for long-term investing, I would say, to be safe, 5 years plus. That's kind of my goal. So that's pillar number one, long-term mindset. Number two, diversification, right? I never want to put all my eggs in one basket. I never want to go all in. Even if it's my favorite company, a company that I know you and I both love, like Enbridge, right? I love Enbridge stock. It's one of my biggest holdings, but would I put... It probably makes up probably about like 5% of my portfolio if I had to guess.
Yeah.
But would I ever put 20% of my money into Enbridge? Hell no. That's way too much of a risk, way too much of a concentration in one given stock. And you never know, even if it's the best company in the world. A company like TD, we saw what happened. Like TD is one of my all-time favorite growth stocks, and we saw what happened 2 years ago with the whole money laundering scandal. It tanked because of that, right? Now, has it recovered since then? Yes, because again, I focus on the long term. I knew this was just a short-term thing. But in the meantime, while you're in the middle of that scandal, it's terrifying when you see your stock plummet. Thankfully, I only have, like let's say 6% in TD. So worst case scenario, if my favorite stock like TD or Tesla or Nvidia, whatever it is, if your favorite stock goes bankrupt and goes to zero, worst case, I would only lose maximum 6%. Would it hurt? Sure, but I will survive, right? That's why you need to spread out your money, and not just among different companies, but different industries, different sectors, and different countries. Don't put all your money in the Canadian market. Don't put all your money in the US market. You need a spread of the entire world. And that's kind of one of the changes I've made in the past, I would say 5 to 6 years, emphasizing more on the global stock market.
So I really like diversification, obviously. And there are a lot of ways that you can diversify your portfolio. So there's geographical.
Yes.
And then there's geographical. There's also sectors.
Yes.
And there's also, what else?
I mean, there's also currency diversification, right? Like, I don't want to be investing everything in Canadian dollars. You can, right? And you avoid certain complications like currency conversion and all those kind of fees. But I also like investing in US dollars. I view that as a form of currency diversification because, in the long term, it's hard to predict what's going to happen with the US dollar versus the Canadian dollar. Sometimes you win, sometimes you lose, but I like having access to both, right? Because no matter which one wins, I'm going to kind of win. I'm going to benefit from that, right? So that's another aspect of diversification.
So just like you said before, you're investing in companies for the long term.
Yes.
And obviously Warren Buffett, all the great investors say that. Invest for the long term.
Yes.
Invest in companies that you believe in. They'll stick around for like 20, 50, 100 years. So for beginner investors, how could you tell if a company is going to stick around for that long?
I mean, so that it's a difficult question. So when it's a more established company, we call those blue chip companies, right? Those are the companies that have a long-term track record. Companies like Procter & Gamble, TD, BMO, Enbridge, Coca-Cola. They've been around for decades, even centuries sometimes, right? So we have that track record. We've seen that they've been able to weather the storms. They've been able to survive during World War I, World War II, Great Depression, 2008 housing collapse. They've gone through the worst and they're still profitable. They're still here. They're still providing a service and they're still growing every single year. So those kind of long-term established companies are a very kind of safe bet. I'm not expecting Coca-Cola to like 10x in the next decade, but I expect reliable, consistent growth year after year. Now, when it comes to the newer companies, right, much more difficult play.
Yeah.
You can get really lucky, and I've certainly gotten lucky. I mean, I bought NVIDIA stock back in like 2017, and I've gone up, 750% on that stock.
Is that your highest?
Of all time, yes, NVIDIA would be my all-time best performing stock. But even then, when I bought that stock, did I expect it to grow by 750%? No, at that time, NVIDIA was basically just a computer graphics company.
I want to know. I want to know your rationale at that time on buying NVIDIA. So
that one was a little bit. I almost had almost industry knowledge because I was working as an AI engineer, right? So at that point, we had a pretty small team at the company, the AI company we were working for. We were building AI models to kind of solve healthcare applications. And even though we had a relatively small team, we used exclusively NVIDIA products. All of our GPUs were NVIDIA GPUs, right? And then we actually invested into...
What was that, like 50 years ago?
This was not that long ago. 2017, 2018. But we even invested into this, I forget what the model was, but it was this giant golden NVIDIA, giga computer, basically. I think we spent like
NVIDIA computer?
It was like a giant, it was literally gold. It was a gold, NVIDIA, multi-processor GPU box. It was crazy. I think we spent like 120 grand on that box. But this thing was a beast, right? If I was training an AI model on my laptop, it would take 3 days to train. This thing would spit it out in 15 minutes, right? So that was just kind of I had that kind of insider knowledge, knowing that every single time we're buying hardware, we're always buying NVIDIA GPUs, right? And NVIDIA had already been around for decades because they were at that point they were really well known as computer graphics cards makers, right? So for anyone who does PC on computer gaming, they make 9 times out of 10 they'll be using an NVIDIA GPU for that, right? But since we were kind of at the cutting edge of AI, and we knew that they were so far ahead of the curve in terms of the AI GPU, their functionality, I kind of invested pretty heavily into NVIDIA. I think this was probably around 2017, 2018. If I remember, the stock price was probably around, I want to say around $200 a share. This is before their stock split, right? So
I was just going to say that.
After the stock split, I think my guess is probably worth maybe $5, $6, $10.
Wow.
And now, it's literally gone up 750%. That's 8.5 times growth, right?
Right.
And a lot of that was, that was definitely luck, right? Because I knew it was going to grow and I had trust in the company. I had no idea it was going to grow to that extent. No one could have predicted COVID.
Yeah, that's true.
No one could have predicted the AI boom that came after that. But I kind of, one of those kind of beginner lessons you'll hear that a lot, that kind of beginner wisdom you'll hear a lot is, if you don't know what companies to pick, invest in what you know. Invest in what you spend. Invest in the companies that you use day to day. Whether that's companies that you shop at, banks that you use, utility companies that you pay your utilities with.
Yeah.
Look at the products around your house. Your toilet paper, your toothpicks. Invest in those companies that make those products. Those are called defensive companies. They're always going to be in demand, rain or shine, right?
Yeah.
And for me, NVIDIA was definitely not a household name back then, but since I was working in the industry and I knew that this industry was only going to grow faster and faster, and no matter who dominated the AI software world, I knew that NVIDIA would dominate the hardware side of things. So I kind of had that kind of, industrial knowledge of the company.
Yeah, well, you got super lucky there.
Yeah.
I wish I was your friend back then, but guess not. So I wanted to kind of get into, I don't know, I forgot.
That's okay.
Is it okay if I ask you if you've ever had like a huge loss?
Sure.
Okay, that's great. So I want to know, since NVIDIA obviously is your highest returning stock, do you have any losers that you would like to share?
Absolutely. I don't care who you are. Even if you're Warren Buffett, when you're picking individual stocks, you're going to have losers. That's the name of the game. Now, that's why the key is diversification. You don't want to be, if you only buy 3 stocks and one of them's a loser, your portfolio is probably going to be hurting, right? But if you own, 20 stocks across different sectors, you might have 1 or 2 losers, but the other ones will be winners. So as an example, probably my biggest loser would be, I would say, Allied Properties. That's a real estate company that invests in office properties. So I invested in this company probably around 2018, 2019. Again, because of kind of industry knowledge. I knew that they were kind of moving towards converting old factory buildings and revitalizing them into like desirable kind of chic office properties for tech companies.
That sounds pretty good.
Right? The building I was working in, we were building it. We were working in this old factory that was kind of converted into a tech incubator. It was owned by Allied Properties. The Google complex in Waterloo, literally across the street, was owned by Allied Properties, and I knew that they were just building. They were hiring, hundreds of employees, right? So I was like, you know what, this company, I see bright things coming for them. Again, this was like 2018, 2019. What happened a year later? COVID. Work from home, offices were shut down for years. Here we are 5 years later. Most people are still either working remotely or working kind of a hybrid model, right? So office real estate has taken a massive beating, and we're still not even close to recovering. So that stock, I'm still probably, if I'm honest, once you factor in dividends and stuff, I'm probably doing okay, but I'm still probably down at least 30%.
Oh, you still have it in your portfolio?
I still own it. It's not a lot. I probably put in, to be honest, maybe I put in like 1,000, maybe 1,500. So I'm probably down like $200 or $300. For me, it's not really worth selling. I don't think the company's going to go to zero. I know that they will recover. And in the meantime, I'll collect those dividends and I'll wait for it to recover. But if it was a bigger chunk of my portfolio, then I have a more difficult decision. Do I hold on and wait, or do I kind of cut my losses and move my money somewhere else with a better opportunity? This is such a small amount of money, so I'm not really all that concerned about it. But that's one example of one of my losses. And again, I had pretty strong conviction, and all the signs were moving in the right direction. I saw the numbers were good. As a company, they were doing well, and I had kind of I had my feet on the ground. I could see exactly what they were building in my neighborhood. But things out of my control.
Sometimes you get lucky, like with NVIDIA, and sometimes you literally get unlucky.
Exactly, and the worst timing. No one can see it coming, right?
So, make sure you're diversified.
Yes.
Obviously, that is like the key takeaway here.
That's the only way to protect yourself. That's the only way.
So you are, like, out of all of my friends, you are the guy who knows about registered tax accounts.
Yes, I'm the tax guy.
Tax guy. Literally, I was just asking him about my business taxes not too long ago. Basically every day.
Pretty much. Yeah, I'm always here for you. For me, it's fun. I love talking about this stuff.
Okay, great. Well, let me ask you a question that I think every beginner investor wants to know, and that is, if you had money to only fund one registered account, like the TFSA, RRSP, or FHSA, where should they start? They all have very different rules and regulations.
Yes.
But for a beginner investor, what do you think is the best account to start with?
So you're right. They all have pros and cons, and they all have different uses. And it's not going to be a black and white issue. It's not going to be a one size fits all. It really will depend on your situation, your goals, all that kind of stuff. But if you're a beginner investor, here's my overall advice. If you don't own a home yet and you're looking to buy a home in the next 15 years, then your priority should be the FHSA, the First Home Savings Account. And the reason for that is because the FHSA literally has all the benefits of the TFSA and the RRSP. So the benefits of the TFSA that it kind of stole from are its tax shelter growth, and when you withdraw the money to buy your home, 100% tax-free. It also takes the benefits of the RRSP, meaning the tax deductions. Every time you put money into your FHSA, you get to claim a tax deduction. You get to lower your tax bill, meaning you get like a check from the government, right? Like you get a tax refund. So I'm saying if you don't own a home yet and you're looking to buy a home in the next 15 years, the reason why I say 15 years is because you can only keep that account open for 15 years. So if that's you, if you're buying a home in 15 years, invest in the FHSA, max it out, put in $8,000 every single year into it, and depending on your tax bracket, think of it this way: if you put in $8,000, you can get a $3,000 tax refund, right?
Yeah.
And when you eventually are ready to buy a home, withdraw all that money tax-free, right? So that's huge.
Okay, one question.
Yes.
So what happens to that money after 15 years? Let's say you're like, I don't want to buy a house anymore.
Yeah. So if you decide that you're never going to buy a house, you have two options. The best option is to buy a house. Like that's literally what it's designed for, and that's where you get the full package benefits, right? If it's not on the cards, if you know you're not going to buy a house, then your next best option would be to convert that money into an RRSP. So basically, the way I look at it is like I'm saying, even if you don't end up buying a home, in the worst case, the FHSA basically becomes a free gift, an extra $40,000 of RRSP room that you didn't have to earn.
Yes, we love that.
Right? And then the third option, the worst case scenario, if you don't want to use the RRSP and you don't want to buy a house, then you have to withdraw that money, but you'll pay taxes on that withdrawal, just like you would with an RRSP withdrawal.
Ooh,
right? Which is why I'm telling you.
That is crazy.
That's why it's so, if you're buying a house, you withdraw the money tax-free.
Right.
Like I can't overstate how powerful that benefit is.
Right.
So please use it for what it's intended for, to buy a home.
Yeah, so.
If you're not, then it ends up being a taxable thing like the RRSP. And
so
you don't. I'm sorry to interrupt, but also with the RRSP, you can delay those withdrawals until you're 65 in retirement. This, you only have 15 years.
Yeah.
Right? So
yeah, that would be like the worst option
case. Don't do it.
Well, here's why I had such like a negative reaction for when you have to pay taxes. It's basically taxed as if you were making this income.
Yes.
So for example, let's say you have like 300, 400,000 in your FHSA. You will have to pay 300, 400,000 as if you made that money from a regular job. And you have to pay the taxes for your regular job as well.
Yes.
So that is the worst thing you could do.
And you lose the time. You lose the benefit of flexibility. You have to make the withdrawal all at once, meaning you can't even spread it out over a couple of years. Now, it's very unlikely that you have $300,000 in your FHSA because the contribution limit is only $40,000 for the lifetime. Obviously, it's going to grow, but you might be able to reach $100,000 in your FHSA, maybe $150,000. $300,000 is definitely maybe if you bought Nvidia stock and it blew up. But I would say a realistic goal, if you're buying a home in 10 years and you max out your FHSA right away, you could probably realistically get up to $100,000 of tax-free money. That's a down payment right there. So use that.
We're aiming for 300,000.
That's all aim for it. But settle for $100,000.
Settle for 100 for sure. I want to know because I recently bought a condo in 2022, so I'm not eligible actually to open an FHSA. I want to know, will I ever be eligible?
Yes. So the rule is whenever the government introduces these new accounts, obviously they want to help the people who are first-time home buyers. But they don't want to piss off the people who just bought a house last year and just missed the cutoff, right?
I was pissed.
Yeah, I get it. It's kind of like, I remember what happened when it's certain university loans would be forgiven by the government, right? And it's you bust your butt paying off those loans, and then a year later the government kind of forgives the loans anyway. You feel like you're kind of cheated, right? And that sucks, right? So to kind of alleviate that, they have certain exceptions in the FHSA. One of them is that if you buy a home but you're not living in it, like if you're buying it as an investment property, so you're a landlord, then as long as you haven't lived in that home for the past 5 years, In that case, you're considered a first-time home buyer, in which case you can open the FHSA. That's the position I'm in. I bought a rental property back in 2019, but I never lived in it. It was purely an investment property. So I never lived there. I rented it out right away, right?
Wow.
So even though, yes, I do own a home, I don't live in that home. It's purely an investment property. So I'm able to open the FHSA. But you have the rule is that you can't have lived in it for at least 5 years. You can't just move out of your condo right now and put it to rent and put it in the market and buy it, open FHSA. No, you have to wait 5 years for that. But in your situation, I don't know if you ever lived in that home, but if you didn't, just wait 5 years and then you'll be able to open an FHSA. And once you're ready to buy a home to live in, that money's there waiting for you.
You're right. Yeah. Okay. I was gonna say more, but then you took so much freaking time.
What do you want to say?
Well, I was gonna ask for the TFSA and the RRSP as well.
I can touch on that.
No, we cannot because
super quick. We'll 30 seconds. 30 seconds.
Okay, so So I know that some people, I guess maybe have already decided that they don't want to buy a home. Maybe they're inheriting one or whatever. So talk about the TFSA then or the RRSP.
Yes.
So obviously you're not going to open FHSA unless you plan to roll it over to your RRSP.
Exactly. So I would say if you're not eligible for the FHSA, you already own a home or you decide you're never going to buy a home, then you're stuck with the TFSA and RRSP. And that's a very common question. Which one's better? Mathematically, they're actually identical if your income and your tax bracket remains steady all throughout retirement, right? It's a question of do you pay taxes now or do you pay taxes down the road? But mathematically, they'll be identical. In practice, it's a little bit more complicated than that. So I would say, here's my bottom line. The TFSA has no downsides. It is good for everybody. It can't possibly hurt you. You will always win in a TFSA. It's just tax-free growth and income. It's amazing, right? Now the RRSP, if you don't do it the right way, it can actually hurt you. You can actually lose money with it. But if you are strategic and you use the RSP the right way, it can actually be more powerful than the TFSA. Okay. It depends on a lot of things, but the main bottom line is this. With the RSP, if you're in a high income, if you contribute to the RSP when you're in a high income, high tax bracket during your working years, and then you're going to be in a lower income, lower tax bracket in retirement, that's the best way to use the RSP. And then that way, you're actually going to get more money than you would with the TFSA. But if you're not in a situation, let's say your income's going to be steady, or you think you're going to have a really high pension in retirement, and your income's going to actually grow in retirement, then don't use the RSP. It can actually hurt you. It can actually cost you money. So I would say ideally you want to use a mix of both, right? But depending on your income, your goals, your time horizons, RSP could either be better or worse. But TFSA is always a winner. It's a no-brainer for anybody.
Okay, right. Thank you.
You're welcome.
That is great information from the tax guy himself. So Adrian, for beginner investors, there's always this heated debate. Dividend stocks versus growth stocks. What are your thoughts? How do you think a beginner investor should split them?
Yes.
If they obviously want growth as well, but then a lot of investors now, they look for income as well.
Exactly. So here's the thing, especially, it's never, when it comes to investing or anything in life, but especially when it comes to your money, it's not one or the other. Usually a more balanced hybrid approach is the way to go. And that's what I do. I invest in both growth and dividends. I invest in individual stocks and ETFs. I invest in Canada and the US. Don't just go all in on one tribe, right? But especially for beginners. I mean, you and I remember how scary it is when you start investing, right? And it's a whole new world. It's so unpredictable. And then I'm sure you were the same way. When you invest for the first time, you're probably logging in 10 times a day, checking your money, seeing is it going up or down, right?
Yep.
And in the short term, you don't know what's going to happen. Literally, President Trump could make a tweet declaring a new tariff over China, and then you're down 20%, right? And then you see that red number. It's easy to listen to a content creator like me or you saying, oh, ignore the noise and focus on the long term. But when your own money's on the line, those feelings, that fear, that panic is real. And as a beginner investor, it's natural to feel, scared to be hey, investing's not for me. I want to cash out, sell at a loss, and just move my money somewhere else, right? So especially for beginners, I like to promote dividend stocks because it really smooths out the ride. right? Because if it's a pure growth stock, you're gonna be watching it every single day, watching it go up and down, up and down. You're gonna have green days, you're gonna have red days, and it's gonna drive you a little bit crazy, right? And yes, you hear us say focus on the long term, but that's easier said than done, especially when you're first getting started. With dividends, first of all, dividend stocks are generally a little bit less volatile because they're more established companies. They're more defensive companies. They have a little bit more of a reliable cash flow. So you're not going to see as big swings, generally speaking. But on top of that, even if you do see those swings, you're going to receive that dividend income every month, every 3 months. And when you see that money coming in, it's going to be a huge psychological benefit. It's going to be like a huge motivating factor to kind of be like, hey, you know what? Like I can physically, tangibly see that my money is working for me to make more money and to compound. And it's going to become addicted, right? I mean, I know you felt the same way the first time you felt your
100%.
Your first dividend. You were addicted. You're like, how do I get more? I want to make more dividends, more dividends,
how to optimize.
Exactly, right? So I think that especially for beginners, dividends offer that really tangible sense of security and incentive to keep investing and keep holding, right? Now, does that mean you should go all in on dividends? No. You also need growth. You also need capital appreciation. Remember, there's something magical about a stock. Fundamentally, you still want to invest in a quality company that has a future and will grow as a company. Whether that company pays a dividend or pure capital appreciation, it's basically irrelevant. Now, there is that psychological benefit of dividends, but don't be laser focused on just that. I think that should not be your entire decision-making process. And definitely don't chase those really high dividend yields, right? Because it might look good on paper, like having a 12% dividend yield, but 9 times out of 10, that's not sustainable.
Yeah, that's like
right?
10 times
A lot
higher.
of times, those companies are literally losing money. They're spending more in dividends than they're bringing in revenue. So they can't sustain that. It's only a matter of time before they cut that dividend. They might slash it in half or cut the dividend entirely, and then you're left with nothing, right? So instead, I focus on sustainable and increasing dividends. I know you talk about this a lot, like dividend aristocrats, dividend kings. These are the companies that they might not pay a huge dividend yield, but they pay out a dividend every single year without fail, and they increase their dividend for 25 years, 50 years in a row. That's what I want to invest in. You get that reliable income, that increasing income, and long-term capital appreciation.
Yeah, I guess that is very psychologically beneficial to beginner investors because one, you physically see that there's a track record that they've been paying and growing their dividends, and also their NAV isn't going to go up and down too much. And then, of course, you get the dividends as well, which helps you out. So, So I guess there are pros and cons to both dividends and growth.
And I think for most people, you should have a combination of the two. Now, depending on which stage of life you're at, you might want to focus one over the other, but don't think that one is the right approach and the other one is dumb. No, I think they both solve different problems, and for the average investor, you should have a combination of both.
You're right. Yeah. Well, that's a very good answer.
Thank you.
I love it. Love it. Well, okay. So we're coming to the end of the podcast. I just want to ask one last question. What's one last piece of advice that you want my viewers to take home?
Sure. I'll just reiterate kind of my core fundamental, cornerstones of my investing strategy. 1, focus on the long term. Ignore the short term. Don't try to time the market. Focus on quality companies that are going to be here and profitable 10 years, 20 years from now. That's the key. Long-term mindset. Number 2, diversification. Nobody can predict the future. Nobody knows what stock's going to be dominating next year. Nobody knows what sector is going to be dominating next year. No one can predict if there's going to be a global crisis, if there's going to be a global a war, it could be a financial collapse, it could be interest rates could be shooting up. No one knows. So the safest way to kind of hedge your bets, spread your money, be diversified. And then number 3, if you want to invest, you need money. How do you get money? You need to live below your means, right? Try to increase your income if you can, but at the very least, control your spending. Try to reduce your expenses. Live below your means and invest the rest. And do that every single month. As long as whether that's $50 a month, $100 a month, whatever you can set aside, invest every single month and make that a habit. Be consistent with it and then be patient. and I guarantee you, you will build long-term wealth. It will change your life, and you'll be able to retire sooner. And you and I are kind of a testament to that, right? That's the secret.
Well, from the millionaire himself. So thank you so much for coming.
It was my pleasure. Thanks for having me, Joyee. We'll do this again.
Adrian is a living proof that every small action matters because you are the one who can decide how fast your money compounds. Let me know what your biggest takeaway is from this investing podcast and what your current financial goals are. Please let us know in the comment section. Adrian will also be checking your questions for him in the comments too. Don't forget to follow both of us on Blossom so that you can see our portfolio and get notified whenever we buy and sell stocks. The link to get the app for free is in the description below. You can click this video over here to watch my detailed explanation of dividend versus growth stocks and how I plan to invest in 2026. See you in the next video!